You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Comperl. The U.S. Treasury announced last week that it would increase the size of its buyback operations, removing more off-the-run long-term treasuries from the market using new short-term debt or cash from the Treasury General Account. Secretary Scott Bessent defended the surprise announcement by saying long-term Treasury yields have become detached from their fundamentals. The move comes a few weeks after the Treasury coordinated with Japan to strengthen the yen, an intervention that U.S. officials had not done since 1998. Bond investors are now left to wonder if the U.S. Treasury will conduct additional unorthodox moves that will help slow the rise in long-term yields. On today's special episode of Simply Put, we talk with Brad Setzer, Senior Fellow at the Council on Foreign Relations, about the risks and costs of doubling Treasury's buyback operations, why a stronger yen is in the U.S.'s self-interest, and how these interventions will affect bond yields in the long run. Stay tuned. Our guest today is Brad Setzer, Senior Fellow at the Council on Foreign Relations and a former Deputy Assistant Secretary for International Economic Analysis at the U.S. Treasury. Brad, thanks for coming on the podcast.
Thanks for inviting me.
Our discussion today will focus on two recent interventions done by the U.S. Treasury and how they'll impact the bond market in the short term and the long term. Let's start with the surprising announcement from the Treasury Department last Wednesday that they will increase the size of their enhanced buyback operations from $2 billion to at least $4 billion for securities maturing between 10 and 30 years. Brad, tell us about the mechanics of these buyback operations. What exactly is going on?
Well, I guess the first thing to note is that the buybacks are still pretty small. There was no upper limit placed on the buybacks. If your baseline is $2 billion, you're not buying back a ton relative to the size of the market in bonds over 10 years. The mechanics are pretty straightforward. I guess the Treasury is either going to issue more bills or run down its cash balance to reduce the stock of either on the run or off the run long dated bonds. So it's taking duration out of the market. It's a bid for duration, and it's an effort to, at least in theory, reduce the supply, raise the price, i.e. reduce the yield of longer dated bonds by reducing the amount in the market. But subject to the constraint that the U.S. still has a growing fiscal deficit. So in aggregate, the amount of bonds, notes, duration in the market is still going to be going up.
So they're buying back these off-the-run securities, not at par, just at fair market value, and ostensibly it is to provide liquidity for the off-the-run securities. Is there any evidence that liquidity dropped enough to make this surprise decision?
There's always a difference in price between the on-the-run, the newly issued, most traded bond, and the less traded bonds. There is an argument that you want more on the runs and fewer off the runs, and so that there is a case for doing some liquidity management. But to my knowledge, there was no real distress in the market when this was announced. The sell-off was not a sell-off that was confined to off-the-run issues. The on-the-run bonds were also selling off, so I don't really think this is about market functioning.
So you mentioned that Treasury was going to purchase these longer duration assets, probably with bill issuance. And CNBC reported just this morning that Treasury is considering funding these buybacks using the Treasury General Account. And previously, Secretary Bessent had said they'd fund them using more bill issuance, like a Treasury version of the Fed's Operation Twist. What are the risks, costs, and impacts of increasing these buybacks with either cash from the TGA or more bill issuance? So there's the good, so to speak, of bringing yields down at the long end of the curve, but I imagine there's not a free lunch.
Well, the cash balance exists for a reason. The U.S. government's cash needs to fluctuate, and the cash balance was set at a level to make sure the U.S. never runs out of money, nor does it have to do kind of any emergency bill issuance that would signal distress. Was the buffer set at too wide a level? Was there a margin of safety? Probably. Is it wise to get rid of the margin of safety when the market is generally functioning well? I would say no. The risk is sort of self-evident. You're going to operate the U.S. government with a smaller buffer.
And when it comes to bill issuance instead, if we're taking longer term securities off the market and issuing more short term debt, is there any downside or risk to that?
There's already been a lot of bill issuance, partially because the stock of debt has gone up over the past 5 to 10 years, partially because the share of bills has inched up. So the U.S. has a 20-ish% of GDP, maybe a bit more, haven't looked, stock of bills outstanding. There's a little bit of risk that bill issuance puts upward pressure on the bill market, but at the end of the day, the bill market almost always arbitrages the Fed's policy rate. The real risk is that if the Fed ever enters a new hiking cycle, the increase in the U.S. government's borrowing cost is almost immediate. So a rapid increase in rates would translate into a rapid increase in the fiscal deficit in a way that it hasn't in the past. So I do think there is a risk.
Right, because shorter term debt rolls over quite quickly compared to 10, 20, 30-year treasuries. We've already seen the initial rally fade from the treasury market that followed this announcement, and maybe a part of that is that the operations themselves don't start until September 6th. But what do you think of Secretary Bessent's comment that they're trying to give a signal to the market that they'll use their big toolkit to return yields closer to what the Treasury Department deems fundamentals? How are bond investors thinking about all of this when the Treasury Secretary is saying that Treasury pricing isn't correct?
Well, I think there's a couple of different angles here. One is that it's not at all clear that the Treasury on its own has that big of a toolkit. Unless you're really willing to throw caution out the wind and do a ton of buybacks and really increase the stock of bills outstanding and really run down Treasury General Account, you're not going to materially impact the amount of duration in the market. The Treasury can't do anything like QE. It can't buy just by printing money. It has to buy by issuing bills. Now, there's some similarities, but you really have to do more than just do a few buybacks. You'd have to really change the composition of issuance so that the U.S. essentially goes from being a net issuer of 30s and 20s and 10s to a net buyer of 10s, 20s, and 30s, which would imply an enormous increase in bill issuance or other short-term funding. So unless the Treasury is willing to radically change its debt management, it doesn't have, in my view, all that big of a toolkit. And I think the market is more or less saying, look, we see the size of the fiscal deficit. We don't think it's credible to move too heavily towards bills. And so the market doesn't really believe there's going to be a radical shift in issuance patterns. And if it did, it arguably signals a bit of weakness, which is something the Treasury hasn't generally wanted to signal. So I think the market is right to be somewhat skeptical that this measure, unless it be enormously expanded, will make a material impact on the market.
That's always helpful perspective considering how big the treasury market is. The increase in these operations, it only makes really a marginal difference compared to so many of the other variables that shape treasury market pricing. Now, it's of course impossible to understand this without the context of the fact that long-term yields have been rising quite relentlessly the last few months, especially the 30-year yield. And so coming 2 weeks after the Treasury's quarterly refunding announcement, there are naturally some arguments that this is kind of some manipulation of the market, right? The Treasury doesn't want long-term borrowing rates to be this high, especially close to an election in November. But I want to push back on that characterization just a little bit. So Treasury, of course, has to decide what the profile is going to be on their debt issuance. They can't be entirely passive in this whole thing. Usually, they consult with members of the private sector, what's called the Treasury Borrowing Advisory Committee, to get input on what the market demand is across the term structure, and they announce it once a quarter at their quarterly refunding announcement. As much as this recent intervention does feel like manipulation, for lack of a better term, is tweaking the debt profile ex post like this any different from changing it ahead of time at the refunding announcement? I mean, how do we put this in the context of all the other different ways that Treasury changes their debt profile?
I mean, it is a bit different from a technical point of view. Buying off-the-run bonds is a bit different than reducing the issuance of on-the-run bonds. But it's also just a bit unusual to do an announcement so soon after you've laid out your issuance in the quarterly refunding. The U.S. Treasury generally likes to be, quote unquote, stable and predictable, not surprise the market, let a rather deliberative process play out. So I do think there's something unusual about announcing a buyback that wasn't really discussed at the TBAC, that wasn't part of the quarterly refunding announcement. But you're right, at the end of the day, if your goal is a certain amount of duration in the market, you can achieve that with buybacks, or you can achieve that by changing the quantity of longer dated notes and the long bond that you issue every quarter and reducing the size of the auctions. There's some small technical differences, but the core question is the amount of duration that the U.S. Treasury puts into the market in a context where the debt is going up, where there's a 6% or so of GDP fiscal deficit, and the stock of treasuries outstanding is certain to rise. So if you're going to try to reduce the absolute amount of longer dated bonds or duration in the market, in that context, you really have to do a pretty big operation.
Yeah, that stable and predictable mantra, company mission, whatever you want to call it from the Treasury, I think is really important for this because the buyback started, I believe, in 2024, but that was after a couple years of review from Treasury officials and TBAC and requests from the private sector. And so they had these presentations to really slowly let people understand and give comments on the operations. And so it took at least a couple years before they finally got it out into operation. And then this doubling of the buyback operation size just happened 2 weeks after a QRA. It didn't look like the private sector participants said that they wanted that there wasn't deliberations to kind of prep the public for it. We talk a lot about the Fed's credibility, but when it comes to the Treasury Department's credibility, how does that impact bond yields? If we can't get used to Treasury being stable and predictable, does that impact the market, or are we just reactive to whatever Treasury decides?
It's ultimately up to the market. I share the conventional wisdom that, the bond market is so important that you don't really want to surprise the market. It wouldn't entirely surprise me that after the fact there's a judgment that the negative surprise from moving away from orderly, stable, and predictable comes close to offsetting the positive surprise from an operation that does take some specific bonds off the market and does, in aggregate, reduce the supply of duration.
The other big intervention I want to talk about is the recent coordination between U.S. and Japanese officials to strengthen the yen. First of all, what has caused the yen to weaken from 140 to the dollar in April of last year to about 160 as we're recording?
The yen also was 110 5-6 years ago, so the yen is now incredibly weak. The move over the past 12 months, 16 months, 18 months doesn't actually correspond that clearly with changes in nominal interest rate differentials. So the usual factor that impacts currencies is one currency has a higher yield at various points along the curve than the other currency. And the yield differential between Japan and the US, whether it's the 3-month differential, the 2-year differential, the 5-year differential, or the 10-year differential, has actually come down. So that doesn't seem like a key variable. The real interest rates, though, in Japan have stayed negative. So the nominal rate, policy rate of 1 is clearly below any measure of inflation. The U.S. real interest rate is a little closer to at least expected future inflation, short-term rate. And then the absolute rate differential remains significant, and that directly impacts the cost of hedging. So if you're a U.S. equity investor holding Japanese equities, you actually get paid to hedge the risk. Whereas if you're a Japanese bond investor in holding U.S. bonds, whether it's treasury bonds or corporate bonds or agency or securitized mortgages, you have to pay a premium to hedge. So that has impacted the willingness of U.S. investors holding Japanese equities to hedge, and it has meant that Japanese investors are increasingly going unhedged. And I think that differential in hedging behavior, the negative real rate, I think those two factors are the main drivers of yen weakness. But to be clear, it's not clear to me that treasuries are mispriced. It is clear to me that the yen is incredibly weak on any measure relative to fundamentals. Japan has a current account surplus. Japan's fiscal balance has a lot of gross debt, has a lot of actually high-yielding financial assets too, so net debt isn't so high. Its fiscal deficit is under roughly a percentage point of its GDP, which is much better than that of the U.S. Its primary balances head into zero. It has an enormous stock of foreign assets, and it has a current account surplus. On a lot of variables, Japan doesn't look bad, but because of the rate differential, particularly at the short run and negative real rates, the yen has become very, very weak.
I want to emphasize a point that you just made there about the fiscal situation of Japan, because a lot of people point to their government's widening budget. But as you point out, they're projected to run a primary surplus this year. That's their budget balance outside of interest payments. And this is after years of Abenomics that were much more expansionary in terms of fiscal policy. So I think that is important context. But I want to get back to the last point you just made about how all these different variables show that the yen should be stronger. So you can do some modeling with cash flows or other things to find fair value, but with fiat currencies on the foreign exchange market, there's not really any anchor there. So whether it's 160 yen to the dollar, 110 yen to the dollar, it's kind of all relative to past values. So you can say that the yen has all of these fundamentals that suggest it should be strong, but how do we know what strong is? Can we really tell if a currency is undervalued or overvalued?
Well, it is true that you're always looking for measures relative to history, but you can look at measures relative to various kinds of more fundamental anchors. So one is purchasing power parity. Do the same goods cost roughly the same in similar economies? And in Japan, every test of purchasing power parity suggests that Japan's substantially cheaper. Prices are lower across the board than in the United States. So that's one fundamental metric. Japan is cheap relative to the US. You can also look at the trade accounts. Now, currencies don't always move to close trade balances. Sometimes currencies of deficit countries like the US get stronger. Sometimes currencies of surplus countries like Japan get weaker. Now, Japan doesn't really have a big trade surplus. Its current account surplus is all investment income. All of Japan's accumulated FDI abroad, the Toyota factories around the world, all of Japan's holdings of U.S. in particular bonds, whether it's the government, whether it's the government pension fund, whether it's the life insurance sector, those assets now earn a decent amount of income. And so Japan has a current account of 5% of GDP. Now, that just means that Japan can finance bigger outflows out of its current account. It doesn't have to dip into its stock of assets. But it does in some sense matter. It tells you where the trade and investment income flows, where they are, how big they are relative to the economy. And while it doesn't predict the future direction of the currency, it does provide supporting evidence that Japan's currency is relatively weak. You worry a lot if you have a deficit, an external deficit, and your currency is going up, because it implies an even bigger external deficit, and it would imply the accumulation of external debts. In Japan's case, they don't have those concerns. It's just a different context when you have stronger balance of payments fundamentals. So I do think it matters. Let me just go back, though, to Abe, because I think it's an important point. Abe ran a flexible fiscal policy. It was expansionary a bit in his first year, but it was actually quite contractionary. He raised the consumption tax pretty heavily. And so Japan has actually done a 5-6% of GDP fiscal consolidation since 2012. And that's why they don't run a primary deficit anymore. So I think Japan does need to get some credit for doing a fiscal consolidation, which the U.S. obviously hasn't done, and for bringing its borrowing need down. Now, Takaichi has talked about relaxing some of this austerity, and that is a factor in how much of the market thinks about Japan. But the fundamentals on the fiscal side are of a low flow deficit and a still substantial stock. The fundamentals on the external side are an enormous stock of external assets and large investment earnings from those assets.
So recently, the U.S. has used some of its holdings of euros to buy up the yen in a coordinated effort with Japan to strengthen the yen. The reason why we're talking about it in today's episode. The White House has said they did this to help a friend, but I have a sneaking suspicion that this was not a purely altruistic act. So how is this in the best interests of the U.S.? Why do we participate?
Well, if you're Detroit, if you're a U.S. automaker, you wouldn't be asking this question. Clearly, the U.S. auto industry benefits from having a stronger yen. And given that the trade war with Canada is escalating, I could see how that actually is an important consideration right now. You don't want your tariffs on Canada to give Japan and Japanese production a big edge in the U.S. market. So I do think there's sort of a fundamental trade-based economics point. I also don't actually dismiss President Trump's stated argument. Given that President Trump doesn't exactly always take actions that match or help the U.S.'s traditional allies. I mean, he's gotten into a spat with Korea. We're obviously in a quite serious trade war now with Canada. The fact that President Trump wanted to help Japan is a good sign if you're Japanese. It's a sign that President Trump views the relationship positively. His personal relationship with Abe and now with Takaichi, and certainly Bessent's personal relationship with Takaichi and Japan in general, I do think that is a factor. The impact on the Treasury market, to my mind, more complex. If Japan did nothing and the yen kept weakening, that increases the yen value of Treasuries, and you could argue that supports Japanese buying. You can also make an argument that if Japan is going to act, and if it's acting on its own, it would have to intervene more than if it acts together with the U.S. So by acting together, you can reduce the amount that Japan needs to sell. And then Bessent clearly has tried to signal that Japan can use the Fed's repo facility. For that matter, it could repo bonds in the market. It doesn't actually have to immediately sell treasuries in order to fund its intervention. And so by coordinating, arguably, you can limit the near-term sale of treasuries. But these are complex arguments. It's not super straightforward how this supports the treasury market. It is clear that it helps at the margin U.S. automakers.
Focusing on the treasury market impact, so Japan is the largest foreign holder of treasuries, and so I can see the channel by which they sell off treasuries to then use those proceeds to buy up more yen and strengthen the yen. But what is the magnitude that people estimate in that scenario? I mean, absent this intervention, give us a ballpark of the amount of treasuries Japan might sell off and how much of an impact it would have on treasury yields.
Japan's reserves are mostly held by the Ministry of Finance, not the Bank of Japan. The Bank of Japan acts as its agent. It has roughly $1 trillion in U.S. bonds. Most of that's going to be in treasuries. That's the bulk of Japan's total portfolio. It had, going into this, about $50 billion in bills. It's estimated to have sold, let's say, 80, maybe a little more billion. So more than the holdings of bills, but not so much that, it wouldn't be something that could largely be financed off the natural roll-off of Japan's portfolio, maybe with some additional borrowing against its longer-dated instruments. So you would expect that this would mean that Japan's running down its bill portfolio, it's going to run down its short-dated notes, and then it's not going to be buying quite as much at the auction. Depends on how committed Japan is defending the yen, how much it's willing to sell. 300 is about a percentage point of GDP. Japan conceptually could have sold that, maybe even more. If that was done by selling 5 to 10 years, that could move the 5 to 10 year by between 10 and 20 basis points. But the reality is that that's not how Japan would conduct the operation. It would allow its existing portfolio to run off, and then it would just be a smaller player in the auctions. Japan's pretty conservative in its reserve management, so it's generally buying 5s, not 10s. There would be an impact. if it was a big operation, but I think it's important to understand the mechanics and understand that this plays out over time in the form of reduced demand at the auction, particularly if Japan doesn't fund this by doing immediate sales. And, part of Japan's motive was just sort of to reestablish 160 or 162 as a level around which the market expects intervention. As long as that threat's credible, arguably Japan won't have to sell as much going forward because it won't be tested. Now, we don't know if that's going to play out. Depends a lot on how the Bank of Japan raises rates. I think it's pretty clear they're going to raise rates in September. If they don't, it's going to be hard to defend 160. But it also depends on what happens with the Fed, what happens in the global economy, what happens with oil prices. But big point here is people tend to gloss over the mechanics, and the mechanics are important. There will be less demand at future auctions. With sales of this magnitude of dollars, there doesn't need to be big sales of even 2-year treasuries, certainly not 5-year treasuries.
What are the costs to the U.S. here? I mean, if they used euros stashed away to do this, they assumedly have to replenish those reserves at some point, which means buying up euros using money from the federal budget. I mean, what are the costs to the U.S. from this?
There's nothing that says the U.S. can't have half its reserves in yen and half its reserves in euro as opposed to 3/4 in euro, 1/4 in yen. The U.S. actually only bought somewhere between $500 million and $1 billion of yen. So it didn't sell that many euros. The immediate cost is just giving up a bit of carry. The yen has lower rates in general. JGBs yield less than European government bonds. This is done out of the Exchange Stabilization Fund. The Exchange Stabilization Fund has been funded out of past budgets. It also has some dollars, so it actually has no budget impact, but it will at the margin affect the currency composition and the yield of the foreign currency component of U.S. reserves. To be honest, those financial effects are secondary, particularly at this modest level of sales. I think what really matters is the signal.
So looking at these two interventions, what Treasury is trying to do in the current market environment, and I think specifically in the context of how big foreign exchange markets are, how big the Treasury market is, and then the scope of these two operations, what would you recommend Treasury do right now? Is there a better way to achieve their goals, or do you think any rise in yields is just a market signal that the Treasury Department shouldn't interfere with?
Look, I think the U.S. should stick to changing issuance at the quarterly refunding. I am sympathetic to the intervention around Japan. I think the yen had overshot, but I certainly hope the Bank of Japan will carry through.
Brad Setzer, thanks for coming on the podcast.
Okay, cheers. Thanks for a really interesting question.
This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.